Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing the S&P 500 and why we're on the verge of a technical breakout. A lot of traders and investors are hopping on this bull train. Are you? That is the big question. Are you going to wait for the right signal, or are you going to chase this market higher? Typically, from a professional trader standpoint, when you start to chase the markets, that's when market makers destroy and wreck you. Now, what most people are looking at is this one simple trend line, basically drawing this multi-pivot, this pivot high, this pivot connection point, and you can see we've bubbled up through that. So the markets are on the verge of a technical breakout from this trend line. And being the fact that you actually closed above all of the key moving averages today, even the 200, a lot of people are in bullish momentum and looking to buy this rally. Now, this is actually a potentially dangerous pattern that is forming, especially if you don't get the right market signals across the real breadth of this market, which is why you have to pay attention to a lot of moving parts, and you cannot only be looking at the S&P 500, because the S&P 500 has been greatly skewed, and it's been so skewed in the direction of mega caps that it's very dangerous to just pay attention to this single indice, which is why we look at a broad sector of stocks and different asset classes. Now, with this potentially on watch for a breakout, one thing's for sure, you're lacking volume. Volume trends are not in favor for a bullish trend. Although there could be a little bit more upside, one little parallel channel that I am going to bring to your attention that is much more crucial to watch than this particular downsloping trend line. Let's remove this for a second, and this is a little bit of an insider little secret that I've been discussing, and not even my members have got to see this, but there's tons of information that they're aware of that I think is privy to basically my Trading Capital membership. Now, if you take the trend line and you drop a parallel channel, basically connecting these lows over here, okay, one thing I want you to keep an eye on is this particular trend. So basically, if you take this trend line over here, this was your original topping formation, your head and shoulders, your left shoulder, your head, your right shoulder, that triggered and broke down and had a massive sell-off, and it actually caused you to go all the way down to the lows in October on the S&P 500. Now, why is this channel so important? Because it connects this neckline where you broke down, and basically you've been chopping inside of this channel ever since, failing to ever hit the highs. And you can see a multi-level of support over here off of this massive pierce. You had an impulse green reversal, so that's a huge support zone. You had massive chop along this trend line over here. You basically popped all the way to the center point of the trend line, and now you've actually come back down, bounced off of support, closed back under, and confirmed a break of this key trend line. And now what are the market makers doing? All they are doing is simply retracing back to the original trend, the breakdown zone. Now, from my analysis, we could actually push up and suck in a lot of people at this level. But ultimately, I think if people chase this level, market makers are going to dump this market. That is what my expectations are. And it's very, very important as a professional trader to not get sucked into a 1 or 2 day hype session, specifically when the volume trends do not favor a breakout. Although most people are paying attention to this and this potential breakout here, they're not really paying attention to the bigger range and the actual technical range that we have been stuck in for multi-month session here. So as a technician here, I'm continuing to provide a little bit of insights, and we just have to be aware that based off of how we have consolidated above this range, breaking this range, consolidated on this range again, breaking this range again, just be mindful that when we hit around this 4,067, 4,070 level, maybe a pierce of that, expect sellers to emerge. And because this is at such a critical level, what we could see is that a market makers could try to move this up as if they're trying to cause a technical breakout on the daily chart, and then they could start reversing it lower. So just be mindful that 1 or 2 days does not establish a trend. We still have to keep in mind that we are playing lower highs on this chart right now, so the longer term trend is down. And when you start seeing news sentiment across Bloomberg, across CNBC stating that we are in a new bull market, that's when you really want to be extra careful about going long in this market. One thing I have preached to my members, if you go on the larger term time frame, let me just remove this channel over here so it's easier viewing. One thing I want you to keep in mind, this 100 weekly moving average. Look how long we've been trading below it. The difference between us trading below the 100 weekly moving average this go around is we've been consolidating underneath it as if to go lower. The difference when we broke it here, it was a V-shaped recovery. V-shaped recovery. You know, V-shaped recovery, V-shaped recovery, V-shaped recovery. Then this consolidated underneath it and a big collapse. Basically consolidated underneath it, bigger collapse. So noticing the difference in how markets rebound and recapture key long-term moving averages is key to put yourself in a better position to capitalize on the upside and downside trends of this overall market. So just be careful. The markets could push up, but even if you get another daily close above this, that does not mean the S&P 500 or the NASDAQ is in a new bull market. And real professional traders do not chase price action. They wait for the full technical signals to align with their thesis before they go long. Going long in this market is still very dangerous at this point in time with the amount of risk that is looming in the near term. So there's tons of long setups at this point in time that I think are more favorable than the S&P 500. Based off of the weak breadth in this indice, I am skeptical about chasing this S&P 500. I would rather much look at other sectors, other ETFs, and other indices before I chase this S&P 500 breakout. Now, just looking at some of the other big movers today, obviously Tesla. Tesla had a nice rally today. It was up over 2.48%. Once again, trading the most amount of volume in the market, which is standard. Tesla's at a key inflection point. You're bubbling up against this resistance. You are putting in bullish consolidation. We touched base on Tesla being one of the likely outcomes to pop if we saw a technical breakout in this market. And if that's true, Tesla could inevitably push up to about the 220 level. But again, we really have to be careful and wait for that true breakout signal, which we have not got yet. So just be very careful about chasing this market, especially with the amount of data that is looming. Look at Intel, a massive move on Intel. If you take a look at Intel, it's very rare to see Intel up 7.6% in one day. And just look at this simple resistance trend line that we're bubbling up against. We have not confirmed the breakout, but it is on watch for a technical breakout. So again, semis are kind of going to be that leading market that is very healthy for the overall market to see. But nevertheless, we have to really pay attention to the broad market and what the majority of stocks are telling us rather than the select few heavy-weighted mega cap stocks. On that note, I'm going to bid you farewell and call this video to an end. But just be very careful, as the next couple days in the markets should be very telling for the overall trend. And even if this does break out to the upside, one thing I encourage people to do is if you get a move to the upside, you know, where the S&P does have a technical breakout to the upside, simply wait for the retrace. That way you have a better risk to reward. Buy the retrace back to the breakout zone before you try to chase this. Don't be a FOMO trader. Don't be a FOMO investor, because that's when market makers take advantage of you. If you enjoyed this video, please like and subscribe down below. Leave a comment if this has helped you, and stay tuned for more extra technical analysis. Take care, everybody, and thanks for tuning in.